Welcome to this Killick Explains video, and this time what I want to do is, despite buoyant stock markets, take on a couple of indicators that I'd suggest investors watch that could spell trouble for US markets. All right, now the background to this is what? Well, stocks have been on a roller coaster ride throughout 2025 and continue to do so. I suspect they will all the way through the rest of the year. Basically, we had the Trump trade, when Trump sort of even pre-inauguration came to power. Confidence, people looking ahead saying, great, decisiveness has arrived in the form of Trump. Then it all went a bit pear-shaped around Liberation Day with that raft of tariffs imposed unilaterally across the world. Then, for various reasons, Trump backed down, bond markets got anxious, courts started to challenge the whole tariff infrastructure and the emergency powers used to put it in place. So stocks stage something of a recovery. So at the point where this video is being shot, we're almost back to approximately where we were before the whole tariff palaver kicked off. Now, the obvious question people are asking is what next? And obviously the great answer would be it all continues. Stock markets carry on rising. So is there anything that suggests investors might need to be a little bit cautious about their view that it's now basically upward trajectory for stocks all the way through the second term of Trump's presidency? And I would say there are two things to keep an eye on, especially when they don't move the way you might expect them to. One is government bond yields, and the other is the US dollar. So taking those in turn, bond yields first of all. Now, without going back through the basics of bonds, there are other videos that do that. A yield on a government IOU is essentially the annual return as a proportional percentage of the price. And most of these things, as a quick refresher, are fixed income. And what that means is they pay a fixed amount of dollars, if they're US Treasury bonds, or pounds, if they're UK gilts, to the holder every year. Doesn't change at all. And what that means is the only thing that can change, because these things are in a market, all right, they're in a free market, is the price. So the price tends to move up and down, and that affects the overall yield, all right? So if the price falls, the yield will tend to move up, not because the income's changed, because the price has dropped. And if the price moves up, it squashes the yield. All right, and what generally would you expect to happen in that open market I talked about for these government IOUs? Well, you generally expect that the yield on a government IOU might move sort of in lockstep with the Fed rate, as it's called, the central bank rate. All right. Now, what have we been seeing recently? We've been seeing bond yields rise, and some parts of 2025 they've risen quite sharply. All right, and yet the Federal Reserve have come under a lot of pressure from Donald Trump to cut their rate. All right, now they've resisted that pressure, but a lot of people are saying, yeah, the overall direction of travel is probably down for the Fed rate. It's just a question of how fast you want to go, with Trump being the biggest pusher in that direction. And yet we've seen bond yields, the 10-year Treasury yield, for example, the benchmark one, rising upwards. So what's going on there? Basically, what that's saying is the bond vigilantes, as they're called, which means the big institutions that all trade bonds together in the market, are not happy, okay? Why wouldn't they be happy? Well, number one, they're looking at the size of the US deficit and thinking, you know, what is Donald Trump going to do about this? Now, in the UK, we've got a similar issue, you could argue, but let's stick with that for the moment. The US, you know, basically they're saying it looks like this president needs to borrow lots of money. His tax moves are not crystal clear in terms of how much that'll raise. His government efficiency drives haven't quite worked out. So we're a bit nervous. You know, how much more do we want to lend to the government and at what price? So that's going to push up the yield. And of course, people are worried about inflation. Now, in the US, inflation's remained reasonably subdued, less so in the UK recently. But basically, as soon as people expect that inflation might start to rise on the back of huge government spending programs, for argument's sake, then bond yields tend to sort of go with it. So you've got this situation where, although the direction of travel for the Fed rate might be expected to be downwards, bond yields have been sort of persistent in terms of staying sticky and staying higher than some people might expect them to. Now, indicator number one. Number two is the dollar. All right. Now, the dollar is a huge liquid currency. It's the most liquid currency in the world. Massive volumes traded every day, and currencies are seen as a kind of bellwether for the economy that sits underneath or behind them. All right? In other words, confidence in the economy tends to translate in confidence in the US dollar. Why? Because if you think an economy is doing well and it's growing, all right, you'd expect, all things being equal, interest rates perhaps have to rise at some point. All right, that'll tend to pull up the dollar because people are saying, well, if I can earn a good return in the US by holding dollars, I'll do that rather than holding a currency with a lower expectation of interest rates like the UK or wherever it happens to be. So as a rule of thumb, you would sort of think that if Treasury 10-year bond yields were rising, everyone's feeling happy, everyone's feeling confident, the dollar might rise too, in a sign that everyone's happy with what's going on in the US. But that's not been happening. The dollar actually has had a bit of a mare recently. It's been falling, okay? And it's been happening largely since Trump came to power, or certainly more so. So what's going on there? And I'm afraid the answer could make investors pause. The answer is there's a fair amount of anxiety around about the direction of travel in the US. There's the structural worry about, who is going to deal with that massive deficit I talked about. Is it going to be Donald Trump? Doesn't look like it, potentially, based on some of his spending plans. Trump is hugely unpredictable. He's almost talked down the US dollar. And some would say it sort of suits his MAGA agenda almost for the dollar to weaken. And he's even allowed the genie out of the bottle is cryptocurrency, and sort of almost hinted that there is a future in central mainstream finance for things like Bitcoin, where previously there hasn't really been one. So if nothing else, he hasn't done a lot to defend the currency of his home country, if that makes sense. So all of those things have sort of gone into pushing the dollar down. So what do we conclude from all of this? What you conclude is, if you look at stocks, 10-year Treasury yields and the dollar, all right, as key indicators, they're all saying different things. Stock market's reasonably buoyant, but 10-year yields have risen, okay? Dollar, not doing very well at all. And that's actually quite a confused picture, which is why some people talk about this stock market rally that's happened relatively recently being a sort of hated rally, because people aren't sure what underpins it, if that makes sense. Trump, meanwhile, has got a difficult juggling act. All right, he's got to basically juggle concerns about the deficit with a need to stimulate growth in the US, bring down costs if he can to prove that he can make efficiency in government departments and so on, and balance tax. He needs to raise tax revenue, but he doesn't want to put off all of his support base. Okay, so that's the context in which I say keep an eye on those two indicators other than the stock market, and keep an eye on what they're doing relative to each other as well as what they're doing in absolute terms. Okay, if you're wondering more about bond yields and currencies and some of the things I just mentioned, then there are other videos, killick.com/resources. That's where you'll find my How to Invest in Equities guide with the blue cover and the latest copy of Confidant.